Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'll be your host for the next, let's call 20 minutes here on Options Guide TV. All right, so we looked at Morgan Stanley was our stock of the day on Monday, and Morgan Stanley announced earnings this morning, and the stock is up strong. So our position is doing well in Morgan Stanley. It's up $9 or the stock is up $9.84 or 5% on the day. And that also, and oddly enough, JP Morgan is still struggling, down 1.53%. And then we have Goldman Sachs down $2.98. Now, I do like Goldman Sachs more long-term, and I do think we're going to add it to our paper trading portfolio that we want to watch as a long-term option contract. One of the problems with Goldman Sachs relative to the rest of the stocks inside that longer-term portfolio is that it's a $906 stock. So that makes even deep in the money options expensive. But we're going to buy one of those as because the earnings are gone, we got a little bit relief on implied volatility. Still like the underlying stocks, still like all the deal-making stocks going forward into the end of the year. And, all we need is the markets to need a little peace in the Middle East. And I think we do see the banking stocks rebound a little and become stronger. But really like to move in Morgan Stanley. And that is exactly what we wanted to see from our trade that we put on Monday. So let's go into the Trader Pro software. And one of the things that we're going to look at today is we're going to look at Netflix. That's going to be our stock. They're announcing Thursday after the close, NFLX. And right now we see Netflix is down 52 cents. It's had a real strong move. If you take a picture at the chart over here, this is this pop right here was when the Warner Brothers deal did not go through. Did think that they would have done well either way, but they would have had to spend a lot of money, and a lot of times Wall Street gets upset when people do mergers and acquisitions and spend a ton of capital. And Warner Brothers was not a hot commodity. There's still a lot of debt that's involved in that company. And with that said, here's where that big move came up. A little bit of a pullback just with the general market. Now we're back on pace. I do think that this high is in play. Eventually, you see Netflix going back to that. I don't see any reason for that to stop. AI, a lot of people come back and forth and say, well, it's going to be cheap for people to make content, and it's also going to make it cheaper for Netflix to make content. So I don't know if that's a detriment, but a lot of people have talked about it as a detriment. And I guess it could be, if that's the case, then you want to buy Google, because the people are going to need a forum to put that content in, and Google is one of the best spots to do that. So if you believe that scenario, then you should be long Netflix and long Google. And in my own portfolio, those are two of my biggest holdings. As a matter of fact, I need to trim a little bit of the Google holding to get things back in line. But with that said, let's look at doing a bullish trade on Netflix. I don't see there's nothing in the chart to say this is the perfect spot. I mean, we do have the 200-day, and we're bumping up against that. So that usually stocks will pause a little bit after it's been some time below the 200-day moving average, right? So we spent ever since, when was this? When it broke down below hard was November of last year. Then we have not came back and touched that line. So right now we're hanging out right at it. Let me move this way a little bit. Still can't get that 105 out of there. But with that said, we're hanging out right at it, right at the 200 days. So you can always expect a little bit of a pause, but the catalyst to try to push it through could be earnings. So I like the fact that Netflix is a $105 stock. and it makes it kind of easy to come up with strategies to do around that flex. So we're going to look at our open wing butterfly, and we're going to go a little bit further out. You know what? Let's look at two of them. Let's start with the 9-day scenario, and we're going to buy a little bit out of the money. We'll go just a tad out of it. Well, I'm getting ahead of myself. Let's buy the at the money 106, buy the at the money put 106, and see $7.42. That's the expected move based off of this expiration. By buying that the money call and buying that the money straddle, you got $7.42, and that is going to put us, we'll call it at 112, right about here. 112, 113, right in that range. And so we're going to hang out. That's going to be our precipice of our butterfly. So let's go 4 points. Let's click here. And let's go 109, 113, I think I like. And then we're going to stop short at the 102. Okay. So but we'll do the short-term one first, and then we're going to look at a 9-day one too. So we're going to buy this one. We're going to go 4 points wide here. We're going to sell 2 of these, and we're going to buy 1 of these. 80 cents. Yeah, I like it, because then we got $2, $1.10. All right. So this is 4 points wide. This is our long spread. Remember, this is how we like to set up our butterflies around earnings. We go open wing in a direction. Though we're buying the 109, selling the 113. That's 4 points wide. We're then going, and if we set up a standard butterfly, we'd be buying the 117 put here. And that would also mean that our short spread would be 4 points wide. But instead we stop short and we buy the 115, and then we got a 1 by 2 by 1, and we're getting this done for a net debit of 80 cents. The difference between the long spread and the short spread is 2 points. Means that if the market blows through the 115 level, that the butterfly should trade for $2, and that would allow us to more than double our position. We beat up $1.10. Anywhere above 115, anywhere below 109, we lose the net debit, which is 80 cents on the trade. Let's send it to the what if calculator and highlight everything that I just said. All right, so we're going to pull this on down. This is as of today, if we put the trade on, and it's okay to wait until Thursday if you wanted to do this trade on Thursday. I don't have any problem with that. I don't mind putting it on now. We're doing it mainly because we're doing the show on Wednesday as opposed to doing the show on Thursday. So keep that in mind, that if you don't want the risk of today's market, you just really want to make this an earnings play, you're going to go to the Thursday closer to the close. I'd probably say after the noon hour, and then put this trade on. And that is after the noon hour is always a good time to trade heading into earnings. All right. So here is the direction as of right now, with the pumped up implied volatility because of earnings. Our midpoint is, or our home run, our precipice in the butterfly is right here, right at the 113 level. If it goes to 113, it looks like it pulled in 80 cents. So if it goes to 113, it's worth $4 minus the net debit paid 80 cents. So we're talking about $3.20 or $320 per 1 by 2 by 1 butterfly. If it carries on up above 115, well, then it's trading for $2. We paid 80 cents. So that would be $1.10 above 115 on our butterfly. And our total risk here on the trade is 80 cents. 2-day trade. You're announcing on Thursday. All this time premium has to come out by Friday. So if you put this trade on, right now you're selling $1.26 worth of time premium on the 113, and that has to go away. So expected move is right where our peak of our butterfly is at. If the market goes down, there's nothing that you can do with this trade. You can't adjust it. So be prepared that whatever you put into it, if the market goes down after earnings, that money will be gone. So you want to keep that in mind with any earnings play, because there obviously you have a catalyst that's creating this. But this implied volatility of 113 vol has made this feasible to do. The higher the implied volatility when you put it on, the cheaper the butterfly would be. So 80 cents is very inexpensive, but it is only a 2-day trade. Now it's on Thursday, and you come back and have that trade done on Friday. So here's the earnings announcement, and Netflix always announces after the close. Okay, let's go one more out and take a peek at it and see. We're going to go a little bit wider, and we'll go a little bit further. The downside of a butterfly is that if you are correct on your forecast, you want time decay to happen, or you want implied volatility to come in. And if it's still hanging around, it's hard to make the max profit, or it's always hard on a butterfly because it's got to go to a certain point and stop. But it's harder to make a profit on your butterfly when there's a lot of time premium in it. So we're going to go out to the April 24th expiration, and this will allow us to get a better risk reward. We'll have potential for more upside because we'll go a little bit wider with the trade. All right, so here's the August 9th expiration. Or I'm sorry, the August 9th. The April 24th expiration, which is 9 days away. We're going to still we're going to go with the 109 again, but this time we're going to go, let's see if we get 6 points. So 109, that would be the 5, and then we'd go 3, okay, and the expected move based off of the at the money straddle for this expiration, April 24th, is $8.30. So we're looking at about 115. That's fine, and you can kind of confirm that by looking at the delta. Usually the delta is right around 20 on the expected move. And we have a lot of options. We got a lot of open interest here. So here's the trade. Using the April 24th expiration, which is 9 days away, we are going to buy the 109 strike call. We are going to go up 6 points, and we're going to sell 2 of the 115 strike calls. And then we're going to go up 3 points, and we're going to buy 1 of the 118 strike calls. We can get this done for $1.22 or $122 per 1x2x1 butterfly. That would be our max risk on the trade. If it goes to 115, the maximum this butterfly can trade for would be $6, and $6 minus what you paid for it would be the maximum you could make on the trade, or $478 per butterfly. Now, if Netflix gaps open way above all the strikes on our butterfly, above the 118 strike, which is the highest strike in our butterfly, this trade will still be profitable. It will be trading for, at that point, $3. We paid $1.22 for the trade. That means that we're looking at $118 approximately, everywhere above the 118 level. So going into Netflix earnings, we're going to look to do an open wing butterfly, and we gave you a little bit more upside by going out to the April 24th expiration, but it's a viable alternative to the shorter term, this Friday expiration open wing butterfly. All right. Good morning. All right. Any quote? Kurt, did you do the look at the Morgan Stanley trade? Trade's performing well today, and we're right at 11:20, and I think we're going to call this a day. I think this is where we're going to leave it at. In the Netflix position, and let's review that a little bit. Here is our position that we currently have on, and in here we have a deep in the money call option that we're up about 50% on. We 128 days out, and our net delta is at 92. So if our delta gets to 1, we're going to want to roll this trade. And as a matter of fact, we should probably do that now so we don't take the risk of the earnings on the position. I guess we're going to extend the show. We should do that. Inside this portfolio, here's what we should do. We should roll this position ahead of earnings. Currently we're selling to close the 80 strike. We got to go back. Let's go out. It's only going out 1 month of September. Let's 100 and how many days we got in this trade? 128 days. So let's add 60 days. Let's go about 200 days out. Maybe a little less. Let's see what we got. On the options grid, pull this back, run this direction. We could go to November. That would be 219 days. Or we could go to September, and that's 156 days. Right, I want to go right in the middle. Of course, that expiration isn't available. Let's go out. Yeah, let's do the September. That's fine. We'll do the September one. Okay, so the September expiration, and that's going to be our strike here, September 18th. September 18th. There we go. And now we got to go a little bit. We're not going to have to go as deep in the money as the 80 strike call. So we're going to still look at 80 delta is the 91 strike. And that's sitting right there. The 78 delta is this. We got a little bit more open interest on that option. 44,000 here. And that's the 81 strike call. Going to pay $1 more for that. All right, I'm going to target this open interest, and this is an 81 delta. I normally would look at somewhere between the 79 and 80, but I like the fact that there's this much open interest on a deep in the money option, and because of that, it could keep the markets a little bit tighter. So we're going to actually do this option contract, the 90 strike. Okay, so we're going to go up 10 points. And we're going to go out in time. And I'm really glad I looked at this because this is how we should trade this position. We're heading into earnings. Implied volatility is up. We're up more than 50% on our long call option. We don't really want to give up all those gains, but we still want to be long the call. So we'll be selling some of that implied volatility premium created by earnings, and then we're going to be buying a little bit of implied volatility. We're going to go a little bit further out in time. We're going to start with a 92 delta. That's what we're closing. Normally, you would wait till it gets closer to 1 or 100 delta, but because of the event that is happening, we're going to adjust it now ahead of that event. And when we do this, we're going to be taking some money off the table. So if you look at it, we're looking at the $7.55. That's a net credit that we're going to bring into our account. That goes in our pocket. We're fine with that position. And now we are going to continue to be long, and we're going to roll it out in time and roll back down to an 81 delta. 80 is what I usually prefer, but I'm targeting all the open interest. It makes sense to me to go a little bit deeper in the money to get a little bit more open interest to keep my markets a little bit tighter over time. So I like that. You like open interest. It doesn't necessarily mean that the markets are going to be tight, but you definitely have more people interested in the option contract if there is more open interest. All right. And so we're going to send this one to the trading floor. Let's do it. And there, boom goes the dynamite. We sent it to the trading floor, and we'll let that roll, and I'll adjust it, and I'll make sure that it fills. I think $7.55 net credit is a feasible trade. but because it's the paper trading app, I'm probably going to have to move it a little bit. And then let's go back to the what if calculator. And which one do you think we want to do? Let's Fresh Prince did the okay, good. I see Fresh. Thank you for sharing with us, Fresh Prince. I do appreciate that. It looks like you did let me pull this to a place where I can read it a little better. I did the Microsoft at 110, closed at 290, and letting the other ride in this case. Okay, so closed half of the position. Oh, there you go. Thank you. I appreciate that. Putting it up on the screen. I forgot about that. Let's also, which one do you want to do with Netflix? Do you want to do the shorter term, cheaper one or the longer term one? Which one should be my official paper trade for the day? Because I need to send that one to the trading floor too. Do you want to do the April 24th expiration, or do we do the April 16th expiration? I think that one's the 16th. 17th. 17th is Friday. 16th is the earnings. That's right. I don't know. They're both good. I am a little worried. You know what? I'm not gonna leave this one out to the crowd. I think we're gonna go a little longer, because here's what worries me with Netflix is that we've just had such a strong move, and a lot of times they could take. You never know. We're right at the 200-day, and the marketplace might take good earnings into effect and actually use that as a selling opportunity. Buy the rumor, sell the news scenario. So because of that, I expect it to bounce back. So I want to give myself a little bit more time. But I'm a little bit worried about the initial day after earnings, that there might be a little bit of selling pressure. So because of that, let's go back to the what if calculator. Let's do this one, and we'll send this trade to the floor. And I'll do a quick review of it, and we'll call it a day. All right. Now it's 77. It says a dot. Dang it. Did it move that much against us or with? Well, it was with us. 109. No, that's the wrong expiration. Okay. Yeah, I was going to get upset if it would move that much. This should be 80 cents. Send to the ticket. All right, 79 cents. So we'll put it in at 80. Here's the trade. All right, so open wing butterfly in Netflix, buying the 109, selling 2 of the 113s, and then buying 1 of the 115s. We're going to look at this Friday's expiration, April 17th. The 1x2x1 open wing butterflies trading for 80 cents. We're going to send it to the floor at that. That means we're going to pay $80 per 1x2x1 butterfly. That will be our max risk on the trade. And boom goes the dynamite. All right. Well, this Friday, we're rolling out a new program called Fundamental Friday. I don't know if we'll have the ability to cover the Netflix trade. We're going to be doing some of the basic trades on Friday, but check in 11 a.m. Eastern time. We'll take a peek at the Netflix trade and see how it did, and then we'll go from there. But on Fridays, we're going to start looking at the basics of options. We're going to try to bring in, if you have any traders that are just, sticking their toes in the water as far as option trading is concerned, Fundamental Fridays are going to be a good day for that. And so I put a series of 4 basic webinars together. And if you do sign up for that event, we'll send you that series, no cost, of course. And all that Tradier wants is you to consider them as your broker of choice if you're going to trade options. And with that said, my name's Brian Overby. Thanks for stopping in. We'll see you this Friday, 11 a.m. Eastern time, for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.